Gentlemen, it's a great pleasure having you for our advisory board meeting for the third quarter of 2022. Here with me, my dear colleague Mark Valek, currently in Spain, and he's sweating.
Hey, Ronnie.
Hey, Mark. Then we've got our regular member, Jim Rickards, currently in Rhode Island. Hi, Jim. Good to see you.
Ronnie, great to see you and the whole group.
Thanks a lot for taking the time. And then we've got a very, very special guest, my dear friend, Larry Lepard, currently a little bit outside of Boston.
Thanks for having me, Ronnie. It's an honor to be with you guys, especially with Jim.
Thanks a lot for taking the time. So, yeah, I think there's many topics to discuss today of course, in markets, but also in geopolitics. I'll make a brief introduction for those of you who aren't on Twitter or haven't heard of Larry. Larry, we actually met at the Precious Metal Summit last year in Beaver Creek for the very first time, but we knew each other via Twitter and our email conversations for quite a while. And when we actually met in person for the first time, it felt like, well, we're good friends for decades. So it felt very natural, and we had some great fun and fantastic conversations. So I'm very happy that you're on the call today.
Well, thank you. Yeah, your gold report has always been a big part of my research and is featured in all my letters. So I do feel like I've known you for a bunch of years.
Excellent. I'll just read your biography just briefly.
Don't do that. You don't need to do too much of that.
No, but
I'm an old guy and I'm a sound money guy. I invest in gold.
But yeah. You founded Equity Management Associates in 2006, which is an equity investment management company that invests in growing private and public companies around the world. You're investing primarily into the monetary metals, gold and silver. You're on the board of directors of two development stage gold companies, Amarillo Gold Corp and Rise Gold. Two very interesting companies. You're a frequent guest at many media outlets, including Bloomberg. You're all over on Twitter.
Lots of shit posting.
But prior to EMA, you spent 13 years at Geopolitical Partners, where you were one of the two managing general partners. So that was basically a private equity company, right?
Yeah. So the first half of my career was venture capital, and what happened is in 2008, I got radicalized for sound money. You know, I should have seen it earlier, but when they started printing money like crazy in 2008, I ditched the venture capital and went 100% gold equities and silver equities. So I pivoted, as they say.
We'll also talk about other pivots later on. And earlier in your career, you worked in the M&A group of Smith Barney. You've got a very decent education. You went to Harvard Business School and to Colgate University cum laude, and you're a very competitive CrossFit masters athlete.
I'm not sure I'd call it that. I try.
And a former pilot. So,
Yeah.
Larry, again, thanks for taking the time.
Thanks for having me, guys.
Just a brief housekeeping from our side. We're now basically finished with all the marketing of the In Gold We Trust 2022. We had dozens of interviews, podcasts in June and also in July. Now it's time to recharge our batteries and already prepare for a very intense fall and winter. Mark and I, we're attending many conferences, Precious Metal Summit, again, Denver Gold 1-to-1 in London. Mark is speaking at a big, basically the biggest Bitcoin conference in Europe. We are still very, I would say, busy and also successful with managing our funds and navigating through these crazy markets. We're now up 18% year to date in this in the inflation fund, inflation protection fund that we manage. So it feels good to recharge batteries now over summer, but we're already preparing for a very, very busy busy quarters ahead. And yeah, I think we'll ready to get going now. Larry, I wanted to start with you. You've got this analogy where you basically describe the Fed as a bunch of clowns in a clown car, and they have lost control of the car and they keep bumping against walls. So, Larry, we all know that basically the whole world is waiting for this big Fed pivot, for this U-turn by Jay Powell. We know that inflation numbers are coming down significantly. We know that we are now technically in a recession, although Powell and Janet Yellen, they basically try to pretend that everything is fine because the unemployment is still very low, and on the surface at least everything is still kind of okay. So Larry, do you think that this rally that we have seen over the last couple of days, be it in the equity markets, but also in commodities, in gold, and also in the crypto market, do you think this is already telling us that the market is discounting that we have seen the kind of the peak hawkishness when it comes to Fed policy, or do you think they will continue and we'll see another leg lower?
That's a great question. If I had the answer, I'd be rich. I mean, I'm going to do what Jimmy Rogers says and tell you that my short-term timing is awful, and I'll probably be wrong. I mean, I'd like to think that's the case, and the gold miners got incredibly oversold, and it appears to me that a bottom could be in there, but you never really know. I mean, I think they need to pivot. I think they kind of pivoted, probably a tad early. You saw Kashkari walk it back a little bit after the close on Friday. Where they go from here, who the hell knows? I mean, it's, as I say, what really angers me about the whole situation is that we are forced to speculate for our breadstuffs. I mean, these idiots are running the system, and they're on a knife's edge between extreme inflation and extreme deflation. And they're trying to keep the car right in the middle of this icy road, the analogy I've used, and they keep bouncing off the guardrails. I mean, they were incredibly lax, incredibly irresponsible, and incredibly loose, post-COVID. And of course, they were incredibly irresponsible prior to that, from 2008 to 2015, when they had zero interest rate policy. They kept rates at zero. That totally puts the capital asset pricing model on its head. With a 0% discount rate, the value of any business with positive cash flow is infinite. And so, they've really just completely destroyed price discovery in these markets. And as a result of that, they forced us all to speculate on what a bunch of people are going to say about the economy, and it's ridiculous. I mean, it's like looking at the Vatican and waiting for the white smoke to come out, on every Fed meeting. I mean, it's ridiculous. And so, where is it going to go? I have no friggin' idea. I really don't. I'm not smart enough to know. I mean, maybe Jim has an idea, but I don't. And so, but what I do know is that ultimately it doesn't end well for fiat currency. And I think on that, Jim would agree with me. And so I know how I want to be positioned. I know that didn't really answer your question, but I don't think there is a good answer to your question, Ronnie. It's just impossible to tell with these jokers at the helm,
So let's pass it on to Jim. But I have to agree. I think that the fact that basically everything in markets these days is only about anticipating and interpreting every sentence and every nuance in the communication. This is already quite telling that the system is heavily dependent on low rates and ample amounts of liquidity. And as soon as we're going cold turkey, the market are getting very frothy quickly. And I mean, in absolute terms, this has been the biggest wealth destruction ever. and so far nothing really happened. I mean, in the Eurozone, I don't want to defend the Federal Reserve, but on a relative basis, they did a significantly better job than Madame Lagarde over there in Frankfurt. But Jim, what's your view on recent Fed policy? So do you think we have already seen the highs? Do you think they will pivot already in September, or should we expect more rate hikes?
Yeah, I think we have a very good idea what the Fed is going to do because they always tell you. Now, over time they can change, but they don't change quickly. They signal as much as possible. They call it forward guidance. So I think we have a very good handle on what they're going to do. I'm not sure it matters. I don't think the Fed's very important as a player. I think I agree with Larry. They're a joke, but they're a joke because they don't matter. But everyone goes through the pretense of, what's the Fed doing? The Fed printing money, if that's what it is, and basically we're talking about base money or M0, has no relationship to inflation at all. And that was always true, but it's been very clearly demonstrated between 2009, really late 2008 rather, and 2014 at the end of the taper, they printed almost $4 trillion. And there was no significant amount of inflation. It ran, I mean, it was sort of a sad thing. They were trying to get it to 2% and they couldn't do it. It got to 2% like a month, every now and then, but basically around about 1.6%, well below the Fed's target. Not, it's not zero. I mean, 2% will cut the value of the dollar in half in 35 years. So it's not zero, but and I think it'd be better if it were zero, but even with a modest 2%, they couldn't do that. So, if you print $4 trillion and don't get inflation, you're supposed to step back and say, well, maybe it has nothing to do with it, and it doesn't. And then in 2020, they printed something like $7 trillion. I'm talking about base money, M0, M1, M2 is a completely different analysis. And there was no inflation then. Now, the inflation did arrive in a very strong fashion in the middle of 2021. But that was for other reasons, which I'll get to. So I think we can kind of dismiss Fed money printing as sterile, unimportant, and having nothing to do with inflation. But the markets follow it. So if you're in markets, you better pay attention, not because it really does anything, but if enough people believe it does, then that behavioral narrative, if you will, come back to what the narrative is, can have an impact. So you have to pay attention to it. The Fed, and by the way, the reason Fed money printing has something to do with inflation is because inflation is basically comes from money supply growth and velocity. And what people miss is that, money supply is skyrocketing. It went vertical, but velocity has gone vertical in the opposite direction. It's a Red Bull cliff dive at this point. So, and I remind people that $24 trillion times zero is zero, at least where I went to school. In other words, if your velocity goes down, your nominal GDP is going to go down, or at least it won't go up. You can think of nominal GDP as a race between excessive money printing, which is true, and it's just in the data, and crashing velocity. So you're taking a larger, it's M times V equals nominal GDP, and that's the quantity theory of money. It's not really a theory; it's just a definition. And M has been skyrocketing. There's no question about it. But what the Austrians and the monetarists and the inflationistas miss continually is the fact that velocity has been crashing. It's gone from 8, actually slightly higher, around 10 in 2008 to 1, like 1 and 1.2, and it's still going low. There's no evidence that it has turned around. So like I said, if it goes to zero, you have no economy left, and it's heading in that direction. So, but you take that quantity, that money supply times velocity equals nominal GDP, and you say, well, how much can real GDP be? And the answer is, I mean, Friedman got the velocity thing wrong, but he got the second part right, which is around 3.5%. I mean, a mature industrial developed economy can grow around 3.5%. Now, in the short run, can it grow 5 or 6 coming out of a recession? Yes. Can it grow lower? Sure. With bad policy from 2009 to 2019, pre-COVID, average annual growth was 2.2%. Versus long-term average of about 3.4, and occasionally higher, 4 or even 5%. So, so you can grow below potential, which is really the result of bad policy. If you grow above potential, in other words, if money supply times velocity is greater, produces growth greater than about 3.5%, the excess is inflation. That's what inflation is. But again, this is all definitional. And so Friedman incorrectly assumed the velocity was constant. And in fairness, it was from 1950 to 1980, which is most of his career. And so he said, if real growth can only be about 3.5%, and that's true. And if you want inflation to be about, well, the P, P times Y, if you want P to be about 1 means no inflation, no deflation. It means nominal GDP equals real GDP. So you want that factor to be 1. That's price stability. And if velocity is constant, then you can treat the money supply like a thermostat, dial it up, dial it down, and get maximum real growth with no inflation. That's sort of monetary nirvana. But the problem, as I described, is that velocity is not constant, number one, which Irving Fisher understood very well. It's funny how we actually had this knowledge in the 1920s, and we seem to have lost it along the way. But with velocity declining, all that money printing doesn't mean anything. Now, M1 and M2 are different. That's not created by the Fed. That's created by commercial banks. And that money supply can produce inflation, and does if the banks are lending and people are spending, but they're not. And this is exactly what happened during the Great Depression. All the stuff about gold was the cause of the Great Depression because it tied the Fed's hands is nonsense. I spoke to Bernanke about it. He actually agreed because he had written a book about it. I said, Mr. Chairman, did I understand your book correctly? He said, yeah, you did. And the point is, during the Great Depression, we were on a gold standard, but M0 was allowed to be 250% of the physical gold times the value at the time, which is $20.67 an ounce. Actual M0 was never more than 100%, meaning you could have doubled the money supply, doubled the base money supply in the Great Depression, if that's what you thought you needed, and gold would not have been a constraint. Now, at some level, yeah, 250% is a constraint, but it never was. The M0 never got above 100% of the value of the gold, which means the money supply never got to where it needed to be or could have been. But that's because nobody wanted to borrow and nobody wanted to spend. If you're not lending and spending, and you're not growing M1 and not increasing velocity, if none of those things are happening, and none of them are, you're not going to get inflation. Now, we obviously do have inflation. Where did that inflation come from? Well, there are two sources. One is supply and demand, pretty basic. So there's what they call cost push inflation, which comes from the supply side. And there's demand pull inflation, which comes from consumers. And that gets back to the lending and spending and the velocity and the behavioral aspect and all the things we just talked about. So, but the inflation we have so far has not come from the demand side. Expectations are overrated. You don't really see it in expectations, but expectations are still modest. We have inverted yield curves. We can talk more about that. There's just tons of evidence that no one expects inflation. In fact, they're looking at strong disinflation, if not deflation, by early next year. Again, we'll talk more about that. So where is so it's not coming from consumers, and it's not coming from velocity, and it's not coming from. I remember the 70s. We would wake up and say, "Oh, gee, I was thinking of buying a whatever, new car, refrigerator. I better go buy it right now because the price is going up." That is a big deal. That does increase velocity, and that behavioral aspect is hugely important. But you don't have that today. What you do have, the inflation is coming from the supply side: energy, food, transportation, strategic metals, grains, a lot else, for a variety of reasons. One, obviously Biden's energy policies are disastrous. The war in Ukraine is a factor. The pandemic was a factor. My new book is about the supply chain, and but the research shows that the supply chain broke down before COVID. Now, COVID made it worse, and the war in Ukraine made it worse, no doubt about it. but it started really in 2018 with Trump's trade wars, and that was the beginning of the breakdown of the supply chain, and then it just got worse from there. So that's where the inflation is coming from. The Fed, it doesn't drill for oil. The Fed doesn't run farm equipment. The Fed doesn't drive trucks. The Fed doesn't do anything and can't do anything that affects any of the things we just talked about. So the big question in terms of inflation is, okay, will supply chain get fixed anytime soon? The answer is no. That's going to be years before a new supply chain evolves. Will we get into demand pull inflation, which did happen in the 1970s? That started from the supply side, but it morphed into the demand side, and then it just got out of control. And then we had the Volcker, 20% interest rates and all that. Will that happen? Well, it could happen, but so far it hasn't. And the race is, will we? So I said the Fed can't drill for oil or drive trucks or grow crops. That's true, but they can destroy demand. But if the inflation is not coming from the demand side, how much do you have to destroy demand to actually get inflation under control? The answer is not a little bit, a lot. You have to crush the economy. You can do it. They can do it. But the cost will be exceedingly high. It will be a severe recession because we're not seeing much relief from the supply side. Now, eventually, if you just crush demand, like people, it's not even a question of paying high gasoline prices. You're not buying gas because you're unemployed. If you get to that kind of demand destruction, I think we will, then yeah, the price of oil will go down. But that's not because the supply side got fixed. It's because the demand side got destroyed. So what I just described is a much more extreme version of the so-called pivot. Now I'll shut up in a second, but let me just come back to I mentioned the word narrative. And narratives are very important. Of course, Robert Schiller wrote a great book on this, and he did what we've been doing for a long time, which is actually imported the SCIR model from epidemiology into economics, and which is perfectly valid because if people talk about contagion and financial collapses, well, contagion is from epidemiology. It works the same way. It's not a virus; it's kind of a behavioral virus, if you want to think of it that way. But the math is the same. With recursive functions and superlinear exponents. So and SCIR stands for susceptible, exposed, infected, and recovered, which leaves out dead, if you die from something. But it's a good model and a good book. But he talks about narratives, and I was familiar with the model, but what I got out of the book, I hadn't quite grasped at the time, was that narratives are powerful. They're contagious. They affect behavior and they affect the economy, but they can also be false. Meaning most people say, well, there's a narrative and it's true and it's affecting what we do and it's driving stock prices or bond prices, et cetera, all true. But a narrative can be completely false and still be just as powerful if people adapt their behavior. And you saw this in the Great Depression in the early 1930s. Yeah, I mean, unemployment went to 25% and businesses failed and farms were failing and banks were closing, and all true. But some people had money, even with 25% unemployment, 75% of the people still have jobs. And there were a lot of wealthy people, but it was really considered bad form to be ostentatious about your wealth. In other words, even rich people didn't spend money or not much because they didn't think it was good form, if you will, at a time when people obviously were suffering. And that was the narrative, and that made it worse. And any economists say, hey, if you have some money, please go out and spend it. The more the better, because that's the only way we're going to get this economy moving. But they didn't. Beginning in 1933 with Franklin Roosevelt, the narrative flipped, and all of a sudden, happy days are here again. And people said, I really should go out and spend some money, and they did. 1933, 34, in the middle of the Great Depression, were two of the greatest years ever in the stock market. It wasn't until 37 when our friends at the Fed screwed it up again and caused a second severe technical recession in the middle of the Great Depression that the whole thing died out. But 33, 34, 35 were actually pretty good years. The problem is unemployment went from 25% to 12%, but it was still 12%. I mean, that was still a big number. So the narrative today is the one you were talking about, Ronnie, with the pivot, and it kind of goes like this. Yeah, inflation's bad, but the Fed is determined to squash it. They're raising rates very aggressively, which they have. They're also reducing M0, which the best estimates are that every $500 billion of reduction in the balance sheet is roughly equivalent to a 50 basis point rate hike. And their schedule is 80 billion a month. It's 960 billion, or basically $1 trillion a year. So at an annual rate of $1 trillion of reduction M0, that's another 1% rate hike equivalent, in addition to what they're actually doing with nominal rates. So this is, you say, hey, you're going to get the 4.5%, big deal. Well, that's from zero on March 1st. It was zero on March 1st. So it's not just the absolute level, it's from a standing start. That we haven't seen rates go up that high that fast since Paul Volcker. So they're doing that, but then they just continue. Then I was like, okay, and that's going to hurt demand. If you're filling up your car and buying food, you don't have enough money for dinner out or whatever. That's going to cool things down a little bit. The inflation will come down quickly. The Fed will see that. Then they'll actually pivot, maybe late this year, early next year, to rate cuts. And that's good for tech stocks or buy stocks. I mean, that's sort of, I sent out a little supplement to one of my newsletters on Tuesday morning, last Tuesday morning, the day before the Fed decision was announced. And I said, they're going to raise interest rates 75 basis points. Well, that was easy. They told us. Just read Nick Timiaris in the Wall Street Journal, and he's the designated leaky when the Fed wants to leak information. So that was easy. But I said, stocks are going to go up a lot. And my forecast, which I'll get to in a second, is that stocks are going to go down a lot. But you have to understand that most stock trading, about 95%, is robotic. And the robots run on, I hate to break it to retail investors, but it is. They run on algorithms. Algorithms are written by coders, some of whom, 27-year-olds from Bangladesh who don't get out much. And the coding is based on narratives. And the narrative is the one I just described. And so if you believe all of that, then you should buy stocks. And they did on Wednesday and Thursday. But here's what I would say is the reality. And narratives can win in the short run, but reality always wins in the long run. And it's easy to describe both. What's hard is saying, okay, where does the flip come in? Where does the narrative just die? And here comes the reality, and it's like a punch in the face. And now we got to figure things out. Sometimes it's a long time. You lose a lot of money being right, but this will happen. I think, in relatively fast order. It'll go like this. I mean, I love Jay Powell. Jay Powell said, well, we just did 75 basis point rate hike, but we don't know. We're probably going to keep raising rates. Don't rule out 75 basis point, but we're not going to tell you. We don't have any real guidance for you. And then he proceeded to say exactly what he was going to do. So you just have to listen to Jay and believe him. But he said, and this is a little cryptic, but he said, I think by the end of the year, we'll get to where the average of the dot plot indicated based on the last meeting. There were no dots this meeting. By the way, I just know from inside the Fed, the dots are a joke. They wish they had never started them, but they can't get out of it because everyone pays attention. The journalists got to write about something. But he said it'll get us about where the dots said. Well, that was 3.5%. So if you're 2.25 right now, which we are, and you're going to be 3.5% by year end, which is what Powell said, and there are 3 meetings left, that's 50, 50, and 25. That's the 1.25 into plus 2.25. It gets you 3.5. So he kind of told us they're going to do 2 50s and a 25. So 50 in September, 50 in November, and 25 in December. So the Fed told us what they're going to do. That's down significantly from 75. Don't believe for one second. Anyone tells you the Fed's not political, that's nonsense. It's one of the most political institutions you can think of. They don't want to. It's not that they favor Republicans or Democrats. They actually just want to keep out of things. And we have a big, significant midterm election coming up in November. The Fed could raise rates more aggressively, but then when the Democrats lose, everyone will blame the Fed. they could raise them less aggressively, but then the inflation will continue and everyone will blame the Fed. So they're like, hey, we're just going to smooth this out a little bit. So look for 50 in September, 50 in November, but that's kind of, I think it's like a day or two after the election, and then 25 in December. That's what they told us they're going to do. But a couple of things. Number one, that's not exactly a pivot. That's, you're still raising rates. Okay, to reduce at a milder rate, but that's not the pivot. And will they cut rates in January? I doubt it. The Fed doesn't. They might stand pat, but it presupposes the inflation is under control, and that, to the extent it's coming from the supply side, it won't be under control. So, and we're already in a recession. So everyone except Janet Yellen, who doesn't really know much about economics, and the White House would agree with that, but they're saying, look up, it's not a recession. Of course it is. But again, going back to the narrative, it's a fairly mild recession. Down 1.6 annualized, down 0.9 annualized. They're not trivial numbers, but that's not like 2020 or even 2008.
Not yet.
Not yet. Well, that's my point. That the narrative is a shallow recession, a pivot by the Fed. Happy days are here again. Buy stocks. The reality is, the recession came sooner than we expected. It's going to get a lot worse. The Fed may try to pivot, but they won't. And stocks are going to go down, 30% or more. But that reality won't become really apparent until late this year, because in the short run, the narrative is too powerful.
Thanks for this short answer, Jim. But we all learned a lot. So I think it's interesting that the market is already pricing in rate cuts for January, and I had a look at the euro dollar curve. It was cuts of 125 basis points for 2023 already. And we're already seeing, that the curve is being inverted, and the swaps curve even more inverted than any time since 1990. So I think the market is already telling us, well, this is going to be a nasty recession. And I think, just as a side comment, I think what most people don't really have in mind is, I think that everybody kind of waits for the pivot, and then we're seeing the everything bubble being reinflated. I think nobody really expects a nasty sideways market with bear market rallies and then big drawdowns. So kind of a 2 or 3 year long or even longer sideways market, volatile sideways market, which would basically be the nail in the coffin for this. Everything has to be passive. Just buy ETFs. You don't need an active asset manager. I think that's something that is kind of not expected by many market participants. Mark, we did send out quite recently an update of our inflation signal, and I think many of our followers were quite astounded that our signal is actually showing disinflation. Perhaps you could briefly outline what the signal is telling us, and also how we basically implement this signal in our portfolio currently.
Correct, Ronnie. So what we are trying to gauge, and we've been doing this actually for almost 10 years now, seems crazy, is we want to see what is the market telling us in terms of inflation momentum. And we don't look at any inflation statistics, price inflation, or anything of that, because first of all, they're lagging, they're backward looking, and they've got all sorts of flaws associated with them. What we are looking at is only at market prices, and then we try to find some kind of the momentum, define the momentum. Is it going up? Is it going up strongly, not so strongly? Or is price momentum according to markets and inflation sensitive assets even going downward? And exactly that happened. So we had a very high inflation, so that the highest possible inflation momentum. So price inflation seemed to be going up very highly, which obviously was confirmed by the official CPI. rates and so on. And in the beginning of July, it switched, and we first, I mean, the momentum got weaker, and the beginning of July it even switched into a falling price momentum, inflation momentum, and I think that's as you said, very surprisingly for a lot of people, especially, I mean, also we who have been historically rather in the inflation camp. You would perhaps suspect that we have a bias towards inflation, long inflation, and so on. But specifically for that reason, we actually work with this inflation signal, and it has profound impacts also on our investment decisions. So we were able to basically reduce our inflation sensitive assets in the first half already, when the momentum got weaker, and are now completely out of most inflation sensitive assets, with even long duration positions on. And yeah, so we readjusted our portfolio completely. And I think it's interesting to follow. So if your listeners want to be on our lists, we have a research list, distribution list, where everybody can get on this email list.
Could you also briefly explain the strategy that we implemented regarding the miners?
Yeah, so I mean, we're talking about equity miners. What's interesting about inflation momentum, also in our view at least, is we've got like different kind of durations. So if some assets are more sensitive for inflation expectations on the shorter term, and some are more perhaps sensitive on the medium and long term. And we would put gold into the category of being more sensitive to the medium term, actually, not so much to the short term inflation. And what we did put on was a quite a big trade on mining equity. This is very recently, but we've got a protective put on our biggest mining positions. So we basically got long call gold mining equity position, implemented that in the end of July, or during July actually. And the idea is we could see now this inflation momentum drifting down, but in the longer term, actually, it may reverse. But we've hedged this bet basically, and got a long call GDX or gold mining position, which I think is very interesting due to the very low levels which we are right now.
Ronnie, could I drop a footnote on your comment about the inversion of the Eurodollar futures curve?
Sure.
By the way, my models are showing exactly what Mark just described. It's not outright deflation, but a disinflationary trend. So different methodology, but sort of turning up the same result. But I think it's important to understand what Eurodollar futures actually are and what they're signaling, because I think that not you, but I think the market is misinterpreting it. They're saying, okay, Eurodollar futures are inverted. That inversion point has been coming in very rapidly, meaning it was out in the middle of 2024. And now it's like March 2023. It might actually be December 2022 at this point. So it's come in so that it's really only a matter of 5 or 6 months away. So people look at that and they go, oh yeah, that's a very powerful signal of interest rate cuts, and so the Fed's going to pivot. That's a non sequitur, meaning it is a very powerful signal of interest rate cuts, but it's not the Fed funds rate, and it's not binding on the Fed. Don't underestimate the ability of the Fed to screw this up. That is that is a bet on a rate of how major banks lend to each other in the interbank market, and the price of collateral on $1 quadrillion worth of derivatives. That's what that price is. And it's real money, and it's where the big money plays, and it's very powerful. But it is not, first of all, the Fed is it's not clear the Fed pays attention to it, number one. I'm not sure they could even look it up on the CME homepage. I'm not sure they think it means very much. There's certainly evidence in the past when they've have discussed it, which is rare, that, so what, it's just a bunch, it's Deutsche Bank and Credit Suisse, who cares? And it's, of course, it's not the Fed funds rate, it's not binding on the Fed. So it is saying that the economy, that the recession is going to be more severe, it's going to happen faster, and interest rates, interbank rates are going to go way down. See, when you look at the Treasury yield curve, it's inverted in segments, I think kind of between twos and sevens, right? Twos and fives right now, and sevens to 20s. That there are these inversions in the Treasury yield curve. But the Treasury yield curve is a short-term look at a long-term rate. It's like what today's market is telling you about where they think long-term rates are. The Eurodollar futures curve is a long-term bet on a short-term rate. You're betting on an overnight rate 6 months from now, or a year from now, or 2 years from now, as the case may be. So just because it's signaling a bad recession first of all, doesn't mean that the Fed looks at it, doesn't mean the Fed understands it, doesn't mean the Fed's going to react. So I wouldn't use it as support for a pivot. I would use it as support for a really bad economy by next winter, for sure, but not that the Fed's going to get the message, number one. Number two, it could be telling us something a lot worse than a recession and slow growth. It could be a pretty powerful red light flashing on a global liquidity crisis, because there are other indicators along the same lines. For example, the Fed has a huge reverse repo program. So they're basically saying to banks, if you want a place to put your money, give us this is not excess reserves. It's to say, give us your money and we'll pledge, Treasury securities. And that's what a reverse repo is from the dealer's perspective. So it's a secured loan, short term, and we'll pay you a certain rate. That's a kind of pretty attractive rate. What auctions and the secondary market trading, banks are bidding on Treasury bills at yields to maturity or that are less than what the Fed will give you for free. So why would you go into the market and buy a Treasury bill with a lower yield than what the Fed will hand you? The answer is you need the bill. In other words, you can't be bound by the terms of the reverse repo agreement with the Federal Reserve. You need the bill. Why do you need the bill? For collateral, to support your balance sheet, to support your derivatives. And we're at a point where counterparties don't want your mortgages. They don't want your 10-year notes. They want 30, 60, 90-day bills, or 1 year or less, but the shorter the better. And by the way, this explains why gold has been performing so poorly, why the dollar is so strong. I looked at a bunch of markets the other day. I was writing an article and I said, well, the yen's down, the euro's down, gold's down, silver's down, stocks are down, and other commodity prices, oil was down. I'm like, what's up with that? Like, why is everything down? Well, the answer is everything is quoted in dollars. When you say gold's down, you're really talking about the dollar price of gold, the dollar price of oil, the dollar price of the euro, the dollar price of the yen, et cetera. And what you have is a super strong dollar. So if you get a strong dollar, the price of everything denominated in dollars should go down. And it is right across the board. Well, why is the dollar so strong? Well, it's because of what I just said about the Treasury bills. If you're a foreign bank, or any bank really, and you want to buy 30, 60, 90-day Treasury bills, you need dollars to do it. So there's a strong bid for the dollar to get dollars to buy the dollar-denominated bills to post as collaterals to support your balance sheet. So when you see that inverted Eurodollar futures curve, and you're absolutely right in describing it, that's telling you that that interbank rates are going to go a lot lower, which is a result of the scramble for collateral and the scramble for the dollar, that the dollar is going to get stronger. And those are all symptomatic of a global liquidity crisis. So recession, yes. Worse than expected, yes. Disinflation, I agree with Mark on that. Maybe deflation down the road, but it's a little too soon to call that. But that could be accompanied by a liquidity crisis worse than 2008. So let's not take that off the table.
Mark and Ronnie, I'm curious, how did you get your 18% year to date? Because I'm not doing that well. What have you guys been doing?
Well, basically, we got the big move pretty right, I'd say. So long inflation for the first 4 months, and then we went more and more cautiously out of inflation-sensitive assets again, also because our inflation signal warned us. And now it's like more on the cautious and long disinflationary side with long duration positioning, and most recently gold mining position, which hasn't had any huge impact yet because it's just fresh in the portfolio right now. But yeah, I think we, Ronnie, we termed the last mailing surfing the inflation waves, right?
Yeah.
I think we achieved this pretty well this time.
And I think, as we wrote in In Gold We Trust report this year, we expect some waves of inflation. I think Jim talked about the narrative, and I think when it comes to inflation, it's also really important to talk about the psychology of inflation. And boy, if I tell you what's going on in Europe currently, inflation is all over. Everybody is, it's really a conversation that you now have at every time you meet relatives, business partners. It's really the topic at the moment, and probably it will kind of wear off over the next couple of months, slightly, but I think over here everybody is really trying to make the best out of this summer and have a good time, because we all know that that this fall and especially winter are gonna be really, really tough. And the energy situation obviously is I'm not really becoming very optimistic having a look at our political leaders. I'm not sure if there's any strategy at all when it comes to solving these issues. And it's Jim, it reminded me very much of the conversation that we had many years ago, when we met for the first time, and you brought out currency wars back then, and we met in person for the first time, and you told us about the financial war games, and said that you came home from this war games happening at the Pentagon or whatever, and you told your wife, well, I've got good news and I've got bad news, and said, well, start with the good news, and you said, well, my team won, but the bad news is my team was Team Russia. I think so. Having a look at the environment at the moment, it's really frightening, and I think all this de-dollarization and all those topics that we talk for so many years already, they're now really materializing. But let us come to the topic of gold, gentlemen. We all know that it has been slightly disappointing, but obviously the enormous strength in the US dollar was one of the major reasons. If you talk to Japanese people, in Japanese yen terms, it's up, I think, 15%. In euro terms, gold is up 9%, and in dollar terms, it's now down, I would say, like 3 or 4%. So it's not that bad compared to equities and also to fixed income. But still, I think we all, to be honest, would have expected slightly more. So do you think that now we're trading at 1780 again? Do you think that the lows are in, or what do we really need for gold to pick up more momentum? If it's not inflation, if it's not turmoil in equities and fixed income, what do we need for gold to make new all-time highs?
Want me to go first?
Yeah, go first, Larry.
Sure. So gold is money without counterparty risk, and gold is cash that can't be printed. So some say, well, we're having all this massive inflation. Why isn't gold working? Well, that's why gold went from 1365 to 2050 a couple of years ago. Gold looks around the corner, in my estimation and my observation of it. And it's also driven by the deficits that we're running and the negative real interest rates. And the deficits have come down substantially. I think that's going to change. And the negative real interest rate has shrunk slightly as a result of the Fed's action. And so, the gold has reacted to that, and it actually reacted to that before those things happen. I think it's now turning the corner. It's about to react to what's coming next, which Jim so presciently alluded to, which I think is, the third Fed mandate is functioning financial markets. And if they continue with the policies they've got going, and they really too try to destroy demand by creating a severe recession, as he points out, and the tell on this, by the way, I mean, my thing that I watch for the tell on inflation is the price of oil. I mean, the price of oil just drives everything, right? The world doesn't run but for on oil and energy. And so, we'll know that deflation is here or disinflation is here if we see oil coming off the boil at 90, 95 into the 80s and 70s. We'll know. And I'm sure that's what they're watching as well. And so my sense is that there's a good chance that something's going to break. It already has broken a little bit. I mean, you look at Sri Lanka, you look at the Italian, debt spreads, you look at CDS on so many of these countries, you look at what's going on in Argentina, et cetera, et cetera. So things are starting to break, and the third Fed mandate is functioning financial markets. And we saw how in March of 2020, when the bonds the US bond went no bid, and they came in and Powell did his I am Mario Draghi, whatever it takes, we saw what they would do when things start to not function. And I think there's a decent chance that something like that occurs sometimes in the next 3 to 6 months, which is why, even going into this, I never really lightened up, probably inappropriately, my positions long gold miners, and I paid for it in this quarter. But the problem is, with these guys driving the clown car, you just don't know, what headline is going to pop out of the ether. And so, unfortunately, you've got to place your bets and hang on through the rough ride. And it's going to be a rough ride. But my opinion is, yes, the bottom is in on the price of gold, and that we will eventually take out the 2050. We bumped up against this 1900, 2000, 2050, 2080 level. We were there in 2011. We were there in 2020, and we were there again earlier this year. And when we take out 2050 to 2075 with authority, we're going to squirt up to 2,500 or 3,000. It's going to be total game on. And people don't see that now. The sentiment has been extremely negative. The narrative has been, that the Fed has got everything under control and we're going to go back to a deflationary environment. And perhaps we will. But if we get back into a deflationary environment, that's going to create a whole different set of problems. They're going to have to deal with that. And so gold will smell it. It'll smell around the corner. And I think it's already starting to smell it. So I'm actually quite bullish. I think we end this year somewhere through the 2050 level. And of course, for the gold equities, the implications are outstanding. So that's kind of how I see it.
Thanks a lot, Larry. Jim, you already mentioned that you're about to publish a new book. I think it's coming out in November, and the title will be "Sold Out: How Broken Supply Chains, Surging Inflation, Political Instability Will Sink the Global Economy." So yeah, I mean that's definitely a topic that we will talk at some point at length. I think it's a very timely book as always. But what caught my eye was a tweet that you made recently, I think July 26th, because you've been to Japan and you wrote, "Nice to be back in Tokyo. Had a great dinner with the Ronin samurai descendant, one of the longest serving Diet members, and a political scholar. Japanese, a straightforward case. We mostly talked about China. Japanese expect a September shock. Wasn't on my calendar, is now." So could you briefly elaborate on the thoughts that you have regarding China?
Sure. Yeah, and it's funny. You get to Japan and meeting with some of the Japanese elites, and one guy codenamed Samurai, but he's the real deal. You would think, well, you're sitting there in Japan, let's talk about Japan. Well, there actually wasn't a lot to say about Japan. I mean, we have we have a good read on Kuroda. He's not going to raise rates. He's not going to do anything. There are reasons for that, having to do with what the Japanese call the descent from heaven. And so, and you got to raise rates to defend the yen. They're not going to. They're just going to leave it alone, at least until the middle of next year at the earliest. They've had eight recessions since 1990. What else is new? An entire generation of Japanese have grown up in a deflationary environment, or at least something close to zero zero, no inflation or deflation, or outright deflation. And they think that's normal. You go down to Ginza, the lights are on, the place is as rich as ever. And I had a conversation with Saki Kibara-san. He was the assistant finance minister, deputy finance minister in the 1980s. He was known as Mr. Yen, but I ran into him not long ago in Korea. I said, Saki Kibara-san, what's going on with the Japanese economy? You got all this debt, high debt to GDP ratio, 8%, well, however many at the time. And he said, Jim, he says, you have to understand, the population's collapsing. So on a per capita basis, we're really outperforming. And I knew the math. I was like, yeah, actually, you're right. But the per capita figures are better than their gross figures because the population's shrinking. And I said, but the extension of that is Japan ends up with like one citizen who owns the whole country. That's kind of what the scholars would call the reductio ad absurdum of what he was discussing. But technically, he was correct that you have to adjust for declining demographics to see to see how they're not doing it quite as badly. But having said that, there wasn't a lot to say about Japan. That's all baked in the pie. But we got into a really interesting conversation about China, and I followed very closely and have been there, quite a few times, et cetera. But what they said is that, and everybody knows there's a lot of resistance to Xi Jinping inside the Chinese Communist Party, and he's ruthless in squashing it. And he's the new Mao Zedong. All that's well known. He's going to get his third term, which will make him de facto president for life or chairman for life, probably this November at the 20th National Party Congress. So all that is, it's not necessarily known to non-experts, but it's out there. Mm-hmm. But what they were saying is that they had some reason to believe that Xi might actually get whacked in September. And I would have regarded that as not impossible. You never say impossible, but definitely very, very, very unlikely. But the fact that, and the Japanese are very close to China. I mean, that's as an important a bilateral trading relationship and as important an outsourcing relationship to Japan as the United States is to Japan. Maybe not in terms of total volume, but in terms of how they think about their financial chains, their physical supply chains, distribution chains, etc. And like I said, they're very plugged in guys. So like, okay, watch the space. I'm not going to make a huge bet on that, but it's good to position yourself so at least you're not surprised. So I thought that was fascinating. And like I say, they were pretty serious people. And now, by the way, I agree with everything Larry said about gold. I think the bottom is in. I think it's a great time to buy miners. I could expand on that, but I think Larry had it right. But I'm surprised. A lot of people are disappointed in gold. Why isn't it 2,000? Why isn't it on its way to 3,000, et cetera? I'm actually impressed at the performance given the headwinds. I mean, given the strength of the dollar, I'm like, why isn't gold even lower? Absolutely. Given the collapse in stocks and not so much U.S. real estate, but what's going on in Europe. Germany's they're going to be freezing in the dark in about 4 months. I mean that's already baked in the pie. I don't think it's priced into markets, but it's coming. Chinese property collapse. You look around the world. Why isn't gold doing a lot worse? And I would say it's performed very well considering the headwinds. If you remove one or more of the headwinds, and let's just say the dollar stays strong but doesn't get stronger, because there is a limit on these things. That's is the euro going to? I spent a week in near Chamonix and Geneva in the end of 2000, and the euro is 80 cents. And we had a group of 7, a couple of families, and we would go out at 4-course dinner, good wine and the works, and we couldn't spend $100 if we tried because the euro was so cheap. And we did try, but so it bounces around. It was $1.60 not that many years ago. So but if the euro's kind of found a bottom, the yen will probably get a little bit lower, meaning it'll go like to 140 or more yen per dollar, et cetera. But that's got to lose some momentum, and so that's removing a headwind to gold. And then the question is, okay, is there a tailwind? Is there a catalyst, something that could drive it a lot higher? Well, certainly the kind of global financial crisis I was describing would do it. And breaking news, Larry said, kind of watch for headlines. I mean, it's now been confirmed. This was rumored and mostly expected, but not confirmed. But it now has been confirmed that Nancy Pelosi is going to Taiwan.
Yeah.
And I would not underestimate. I don't underestimate the seriousness with which the Japanese take this. She is the Chinese rather.
Chinese.
She is third in line to the presidency after Kamala Harris, or say second in line, not counting the president. And to say, well, she's the legislative branch and foreign policies in the executive branch, it's like an American civics class. The Chinese don't believe that. I mean, they're like, hey, she's the most powerful political figure in Washington,
and she's a hell of a trader.
Oh yeah. Well, she's probably going to pick up some stock tips on Taiwan Semiconductor while she's there. But if they decide to divert her plane and 2 planes crash into each other, we put up an F-35 escort for her plane, and People's Liberation Army Air Force flies in, or they declare a no-fly zone and she flies into it. I mean, give me a break. I mean, this is so sensitive and so vulnerable to just a mistake, even if no one's looking for war. That's the kind of thing that will certainly get people to take notice of gold. But I agree with Larry's fundamental analysis. I think it's a good time to buy miners and a good time to buy physical.
Thanks, Jim. Well, Larry, I mean, I wanted to start talking regarding some ideas that you have, and
Sure.
you've got, on your Twitter profile it says fix the money, fix the world, and you're a very vocal and strong advocate of sound money, and I had the delight to give you some feedback on a speech that you delivered at the New Orleans conference, which I thought was a terrific speech. But let's talk a little bit about your fund management style, and also kind of the best ideas that you currently have, if you're able and allowed.
Happy to do it. Yeah.
Okay.
So the fund is 80% gold and gold miners, bullion and the miners, and also silver too, and then 20% Bitcoin and Bitcoin related infrastructure things. But within the gold bucket, which is probably what more of your listeners are concerned about, I'll rattle off a few of my top names. Basically as the major, my favorite major right now is Agnico, AEM, a big holding. There are a lot of other good majors, but that one kind of stands out to me. And I think political jurisdiction is going to become a much more important issue. I'm guessing Jim would agree with me on this. I mean,
yeah, I do.
I think eventually a lot of these countries, and you're seeing it in South America, they're really going socialist. You're seeing, Chile is a very hostile environment now, and all the countries there are going in the wrong direction. So I think where your mines are located is really going to matter. My favorite growing producer is GCM Mining. They just announced a deal to merge with Eris. I'm not very happy about that deal. I don't think it was a particularly wise choice, but even so, it's 30% dilution, and they are getting some future projects. And GCM itself is my largest holding apart from AEM, and it's really a great growing story. Very low multiple of cash flow, paying a dividend. It is in South America, Colombia, and then the development project they have is in Guyana. But Guyana is actually a very favorable environment. A lot of money has gone in there recently to produce oil, and politically, Guyana I have zero concern about. So that would be my favorite kind of growth producer. And then you can get into the drill stories, and there are, plenty of drill stories with plenty of risk. But, I love names like Lion One, which I think is sitting on top of 10 or 15 million ounces.
It's on Fiji, right?
Yeah, it's in Fiji.
We should do a road trip there.
Yeah,
Site visit.
yeah, it'd be fun to go do some due diligence there. Yeah, so I mean, there are tons and tons of drill stories. I like, well, it's not a drill story. A producer that's emerging that I like a lot is I-80, which I think is doing an outstanding job. And I hesitate to list the drill stories because drill stories can go south, but if you're correct, they can also be 10 baggers. So got a bunch of them. Anyone who's interested, shoot me an email. I could give you a few names, but we just invested in Guanajuato Silver, which we think is an outstanding silver producer. They just did a fantastic deal. They bought, in the mining business, one of the things, it's important to buy cheap in mining. And one of the things they were able to do was Great Panther mining is in the process of failing. And so they had a number of assets right next to the Guanajuato Silver assets. And these things were valued at between 70 and 80 million. And because they needed the cash badly, we bought them for $16 million. So we more or less doubled the size of the company by paying $16 million for $80 million worth of assets. And this is a very cheaply valued silver producer that will soon be producing between 4 and 5 million ounces a year. So that's another favorite. I could go on, but keep in mind that within the mining business, Jim knows this well, the mining business is an incredibly tough business, incredibly tough. You're breaking rocks, and it's unpredictable, and you've really got to look for extreme optionality, and you've got to have a number of names because you can be absolutely sure that some things that you think are going to work won't work. A perfect example of that is Alexco, which is a beautiful deposit, but they were you in there? They mismanaged it, and it just got bought by Hecla. Hecla got one hell of a buy, but it was a big holding of mine, and the management team completely effed it up. And that's just part of the way this game goes. Occasionally you get screwed, down 70%. But when you're right, you can get a 10 bagger. And so that's the nature of the mining bets. So that's kind of what I'm doing. And then of course, I do believe in Bitcoin. I'm not sure where Jim is on that, but I think Bitcoin is going to emerge as a digital sound money alternative to gold. It's still quite small, but it's coming along.
Excellent. Thanks a lot, Larry. Well, we'll have dozens of meetings over the upcoming conferences. I know that when I see you at the big mining shows, you're always very, very busy as well, meeting companies, grilling them and asking tough questions. So I really look forward, because I think at these levels there's just fantastic opportunities
Really
out there.
Yeah.
Mark, any questions left?
No, I mean, I think we should start the closing round. Or do you want to end it here? I'm not sure.
No, let's go for a closing round.
Closing round, okay. I mean, I don't know if that opens up too big of a Pandora's box. It probably will, but still, it did spark my interest. Jim is so knowledgeable about these topics, I think, and you already mentioned Taiwan. And so, I mean, I think what is pretty evidently going on is this polarization of the geopolitical world between, call it whatever, east west, probably in the most broadest sense, or BRICS and so on. Obviously it's multi-dimensional, but since you touched Asia, Jim, I guess you would be probably the right guy to ask. I think the US is doing quite a good job, perhaps, to setting up kind of an alliance there. Do you have some thoughts about that? Because I think these are recent developments. I think that's something which one should watch.
Yeah, I mean, I think the U.S. Under the Trump administration, they did a very good job of launching what they call the Quad, which is Japan, Australia, United States, and India. three of which were already allies in different ways. And bringing India into the group makes perfect sense if one of your goals is to be able to effectively interdict maritime trade to China. Well, it goes to the Indian Ocean before it gets to the South China Sea. So, and India is, it's probably in real time surpassing China in terms of the world's largest population. They're kind of tied at about 1.4 billion people each, but India's probably larger, and soon will be if it isn't already. Large economy, technologically advanced, very well educated workforce. Again, I'm talking about a middle class of 300 to 400 million people inside a country with 1.4 billion people. So I'm not minimizing agrarian poverty or the culture that goes with it, et cetera. But even if you have a middle class of 300 million, that's still as bigger than the United States, not total population, but middle class. So you can't underestimate that. So with all India has going for it, it makes sense that it should be in this, what's called the Quad. But as Barack Obama said, never underestimate Joe Biden's ability to F things up. And and you've got some, I wouldn't say lightweight, but medium weight intellects, certainly not stars in the form of Tony Blinken and Jake Sullivan and others, Susan Rice, who are making all these decisions. And they are really attacking India because it has remained neutral on the Ukrainian issue. And to your point, Mark, you have to, it's a big world, but there are a lot of short paths and a lot of dense connections. And a lot of what I did for the intelligence community and the Defense Department over the years was about sanctions and financial warfare. So that was my specialty. They didn't need me to jump out of a helicopter with a knife between my teeth, but I did work on the financial warfare front. And I teach a seminar at the U.S. Army War College, and I told them months ago that the sanctions are going to fail. Russia's winning the economic war. They're winning the war on the ground, et cetera. But I was surprised at the list of countries, very large economies, very important countries, that have remained neutral, that haven't jumped on the U.S. bandwagon. Now, Europe, I think soon to their regret, have joined the United States in this. But India, Brazil, China, Argentina, Turkey, Iran, Saudi Arabia, whether it's friend or foe, these are all important economies, regionally or globally, and none of them have joined the sanctions. For that matter, the UAE has not joined the sanctions. So, but the U.S. is coming back aggressively at those who have not, including China and India. So while the Quad got off to a good start in 2019 and 2020, it's sort of under a lot of stress right now because the U.S. is confronting India for, in my view, no good reason. But so we'll see how that plays out. And then, of course, the other thing to watch is the war in Ukraine. But Russia's winning. They're going to win. They're going to keep the third, maybe more of it. The longer the Ukrainians fight, the more the Russians will end up having, with sort of Odessa next on the hit list. But we'll see I think what I expect is they'll whack Zelensky. Either he'll be assassinated or removed. Maybe if he's lucky, he'll make it to his place in Florida, and they'll put in some new leadership who will negotiate a truce with the Russians. That may be that's what they should do. They should have done that before the war, but that's where this will end up. Just a question of how long it will take. And Europe is running energy policy by press release. He said, we're not buying any more oil from the Russians. We're not buying any more natural gas from the Russians. We're going to reduce it 15. And they've had this series of press releases. They haven't actually done anything. If you read the fine print, the deadlines, one had a deadline of August 31st. We're still a month away. One had a deadline of year end. It was almost as if they were extending the deadlines in the hope that the war would be over before they actually had to live up to any of it. And they can't live up to any of it because there are no easy substitutes. I know a lot about Qatar. I mean, they have tons of natural gas. They're selling it all to China on like 10-year take or pay contracts. The idea that Qatar has a big surplus of natural gas that they can ship to Europe if Europe even had the LNG terminals, which they don't, they have some, but not enough capacity, is nonsense. So it's just sort of fantasy world. But so yeah, Europe's going to suffer severely. Germany in particular, of course. I think the war will drag on because the U.S. wants it, and for reasons that we spend another 2 hours on that. But I'll just say that U.S. policy is pretty misguided at this point. So yeah, no shortage of geopolitical crisis going on. Probably good for gold.
Thanks,
Yeah,
Jim.
Thanks for that.
Larry, as you are our special guest, final word, perhaps something on a more positive note.
Yeah, look, I think the positive note is that probably most of the people listening to this are invested in sound money assets, and I think that sound money assets and commodity assets are going to be what's going to perform extremely well. I mean, as Jim so correctly indicated, this cost push inflation, it's not going to get solved overnight, and the amount of demand destruction the Fed would have to create in order to solve it is ridiculous, and they're not going to be able to handle that pain. So it's a pretty safe, and as you guys have so well pointed out in your books and your most recent report, the tide has shifted, and we are now in the age of commodities. And so, Zoltan Posner, so many others have documented it so well. The Russian moves have been documented so well that, and you can't just turn on the tap and create oil. It's not that easy to do. And or a lot of other things that we're short of. And so as a result, you add that the pandemic, the war, you add it all together, and we've got a consistent cost push inflation problem here for many years, at least several single digit years, and perhaps 5 or 10. And although inflation will wax and wane, as Tavi Costa's chart of the 70s so accurately shows, the trend is up. I mean, we're not going back to 1 or 2%. We're certainly not going back to disinflation for any long period of time, in my opinion. And so what I would say is to your listeners is just make sure you're not in, high tech. That's still, in my opinion, overvalued and at multiples that don't support higher interest rates, and make sure you are in the basic building blocks of society, which really are commodities and commodity related things that can't be printed, because we've underinvested in them for a long period of time. And, as Jim points out, this isn't going to get solved overnight. And, Jeff Curry at Goldman Sachs has done great work on this as well. I listened to all his research. It's outstanding. This is the 70s. And in fact, it's probably the 70s on steroids. And I remember the 70s, and, stocks in general sucked. Bonds really sucked. And, if you weren't in oil and gas or gold, it was pretty hard as an investor to make money in the 70s, or real estate. And the real estate didn't even do well until we came out of it and the interest rates dropped. But, my parents had a $40,000 house that did a 20 bagger over the next 20 years. But, that's not going to happen now because real estate's overvalued. So again, I think the bright side is that all these problems that we see, in my opinion, are going to get solved with this reset. It's as you know, Ronnie, I've used the fourth turning model, and I think there are going to be some pretty tough times for people and for markets, and I don't disguise that. I'm sure Jim would kind of agree with me, but I do think that also, the human race continues to improve conditions, and we have for hundreds of years, and unless we blow ourselves up, which I hope we won't, I think we will continue to. And my sense is we're going to be forced into resetting to some kind of sound money standard. We need a neutral reserve currency. We absolutely have to have a neutral reserve currency, or else these problems are going to continue. But I think that when, ultimately this, in my opinion, will resolve via hyperinflation, and that will drive us into that neutral reserve currency. And the reason I say the hyperinflation is going to occur, and this is one area where I would differ with Jim slightly. Jim pointed out so correctly that cost push was a big part of what was going on. But there was also a demand pull side. Where you saw it? You saw it in housing in the U.S. And, it wasn't that the cost of housing went up, although it was going up, but you saw a huge push in the price of housing post-COVID. And what that was people putting on the Hugo Stinnes trade, the inflation king of Weimar. And what you started to see there was the beginning of Gresham's law. So people said, okay, let me see if I can get this straight. I can borrow money at 3%. And buy an asset that I know I need, that'll be around, that can't be easily replaced, at a certain price. I'm going to do that. And so they did. And that's why you saw the housing price pop that we had. And I think, that kind of thing is going to continue, because the way the governments have structured this system is that really their only way out is monetary debasement. I mean, they have another way out. They could pretend to be Volcker and shove us into something that will rival or exceed the Great Depression. But for them, in my opinion, that's political suicide, and they won't do it. They'll threaten to do it. They'll head fake to do it. They've just done it. They'll continue to do it. It's going to be a rough ride. It's going to go up and down. There are going to be all these waves, wave up of inflation, wave down. Like I said, they got a clown car. They're going to bounce off both the guardrails. But when the day is done, they will have to debase and inflate, because the alternative is the entire world is a smoking wreck, and they're just not going to let that happen. And so with that as a backdrop, I think the one thing that investors can do is invest in sound money things, knowing that over time, if they have a 5 and 10 year time horizon, they will be better off than if they don't invest in sound money things. And of that, I'm quite certain. I feel very strongly about. So I hope
Larry, that was
that concludes it.
very powerful final word. Thank you very much for that. Gentlemen, it's been a great pleasure talking to you again. Larry, thanks for taking the time as our special guest. We'll meet each other in September in Colorado.
See you soon in
really
Colorado,
look forward
Ronnie.
to it. Gentlemen, have a great summer. Spend some quality time with the family, recharge your batteries, and I think there will be plenty of topics to talk about in our upcoming advisory board meetings, plenty of stuff to write about. And yeah, again, thank you very much for taking the time.
Thanks for including me. Nice to meet you, Jim. Nice to meet you, Mark. Take care, guys.
Thank you.
Thank you very much.
Thank you both. Take care.
Take care. Thanks a lot. Bye-bye.